In the last class, we discussed relationship of PV ratio with other elements. So with other elements, what is the relationship of PV ratio and what is the effect of PV ratio? We saw the cases. The next concept do we have here is break-even point. After the PV ratio, in the CVP analysis, the next concept we have break-even point. What do you mean by this break-even point? What do you mean by this break-even point? So we know the definition of break-even point, right? It is a point where profit or loss of the business organization is 0. So it is a point where the profit or loss the business organization will be what? 0, means there won't be any profit, there won't be any loss. Or other words, we can say when contribution is equals to fixed cost. When the contribution is equals to fixed cost, that also it is known as what? Fixed cost. That is also known as break-even point. Suppose if you assume this is a sales line, okay, somewhere here this point, this point is known as which point? Somewhere here this point, that point we will call it as a what? Break-even point. This point we will call it as a break-even point. From the break-even point, if you are moving towards left hand side direction, that is completely losses. From the break-even point, if you are moving towards right hand side direction, that will be profits. Okay. So break-even point is a point exactly when there will be no profit, there will be no loss for the business organization. Technically, if you speak in the professional level, when your contribution is equals to your fixed cost, that is also called as which point? Break-even point. So in the case of break-even point, we will continue with the previous example only. So in the case of break-even point, there are two bases. One is quantity basis formula, one is value basis formulas. One is quantity basis formula and another one is what? Value basis formulas we have. One is on the basis of quantity, we have the formula. One is on the basis of value, we have the formula. So on the basis of quantity, first the formula will be. On the basis of quantity, what is the formulas we have? Break-even point quantity is equals to. What we need to recover? We need to recover fixed cost. What we need to recover? We need to recover fixed cost. Fixed cost upon what we need to record? Contribution per unit. Fixed cost divided by contribution per unit. This is the quantity based formula. So what is the formula? Fixed cost divided by contribution per unit. Suppose if you wanted to calculate the break-even point value, see in the previous example which we wrote, in the previous example break-even point value, what is the break-even point value? We got 50,000. What is the break-even point value? We got 50,000. So how can we calculate the break-even point value? Break-even point value is equals to fixed cost, how much? The 10,000 divided by what is the contribution per unit? 20 into selling price per unit. Fixed cost divided by what is the fixed cost? 10,000 divided by, what is the contribution per unit? 20 into, what is the selling price per unit? 100. So that is called as what, Nana? Break even point value. How much we are getting? 50,000. How much we are getting? 50,000. So that is nothing but here the formula will be, the formula which we will use will be fixed cost divided by contribution into sales. What is the formula we will write? Fixed cost divided by contribution into sales. We won't use per unit, Nana. We will remove per unit. Contribution per unit we will remove per unit. Sales also will remove per unit. Okay, na? So the formula will be what? Fixed cost divided by contribution into sales. Again, here mathematics is permitting us to derive more number of formulas. Mathematics is derived. This is the base formula. Fixed cost by contribution per unit is the base. By using this, we can derive more number of formulas. What is the formula we can write? Break even point quantity is equals to, we can write like, break even point value is equals to, we can write like this now. Break even point quantity into selling price per unit. Can we write like this formula? Break even point value formula. Break even point quantity is how much? 500 into, what is the selling price per unit? 100. 500 into 100. That is nothing but how much? 50,000. So this is another one more formula we can write for break even point value. Next, here break even point quantity is equals to, I can write like this now. Break even point value divided by, break even point value divided by selling price per unit. This is the formula we can use now. Break even point quantity is equals to selling price will go under denominator. So break even point value divided by selling price per unit. Next, here if you observe, fixed cost divided by contribution into sales. If you are sending sales denominator, it becomes contribution by sales. Contribution by sales is nothing but what is the formula? Fixed cost divided by PV ratio. This is the formula. What is the formula, Nana? Fixed cost divided by PV ratio. One is quantity based formulas, one is value based formulas. The base formula will be this only, fixed cost divided by contribution per unit. So these are the formulas which we will use on the basis of quantity, on the basis of value. So these are the formulas which we have for break even point. After break even point, there is a one small concept under this. The concept is sales for desired profit. So what is the formula we have, Nana? Sales for desired profit. Sir, what do you mean by this sales for desired profit, sir? What do you mean by this? Sales for desired profit. Sales for desired profit is nothing but sometimes in the business organization, what owners will say, the owners will say for this quarter to the sales people who are there in the organization, they will say for this quarter I required this much of profit, and he will leave it, that's all. So then the costing manager he will think, in order to earn this much of profit, how much of sales we have to do. In order to earn this much of profit and how much of sales we have to do. So that is only called as sales for desired profit. Okay. So let us assume now like this. Suppose let's take one example, then you will understand the formulas. Suppose example, someone is asking desired profit is 5,000 rupees. How much is the desired profit they are asking? 5,000 rupees is the desired profit they are asking. Okay, now let us see the quantity, means how much quantity we should sell to earn a desired profit of 5,000. How much is our fixed cost? 10,000. Fixed cost plus. Why? Because until you recover your fixed cost, there won't be no profit, there won't be no loss. So whatever the amount which you are recovering above fixed cost, you are recovering above fixed cost, that will be your profits, Nana. Why? Because we know break-even point is nothing but when your contribution is equals to fixed cost, means until you are recovering your fixed cost, there won't be any profit. Fixed cost is 10,000 plus desired profit is how much? 5,000 divided by, what is the contribution for 1 unit we are getting? 20 rupees we are getting, means by selling 1 unit, how much is the contribution within 20 rupees we are getting? 10,000 plus 5,000 divided by 20. So that is nothing but how many units more? 750 units. How many units? 750 units. Let's cross check once. Means if you are selling 750 units, then you will get a profit of 5,000. Then you will get a profit of 5,000. Okay, now let's check now. 750 units sales. 750 into 100, it will be how much, Nana? 75,000. 750 into 100, 75,000. Next, 750 into 80, variable cost is 80 per unit, na? 60,000. Contribution 15,000 minus fixed cost 10,000. So how much is the profit, Nana? 5,000. How much is the profit, Nana? 5,000. That's what we got, na? Desired profit is 5,000. How much? 750 units. No, sir. Let us take some other example. Let us take some other example. Let us cross check, sir, once again. Okay. Let us take some other example and let us cross check. Okay. Now, let us take a desired profit. Desired profit, let us take 2,000 rupees only. Let us take how much? 2,000 rupees only. Quantity is equals to fixed cost is how much? 10,000. Desired profit is how much? 2,000 divided by contribution per unit is 20. 12,000 divided by 20, that is nothing but how much? 600 units he has to sell. How many units? 600 units. Let us cross check 600 units. 600 units, let us cross check. Sales 600 into 10, 60,000. 8 6 48,000. Contribution 12,000. Fixed cost 10,000. Profit will be how much? 2,000. Check. We got a, we didn't got a. We are getting. So that is nothing but sales for desired profit means what, Nana? Above fixed cost, whatever the amount you have a desire. Above fixed cost, whatever the amount you have a desire, that we need to add. That's all. That's all. That is only called as sales for desired profit, Nana. That is only called as what, ma? Sales for desired profit. Let us write the formulas for this now. In the case of sales for desired profit also, we have on the basis of quantity, we have on the basis of value. We have some formulas on the basis of quantity, we have the formulas on the basis of value. Now, what is the formula for sales for desired profits? Simple, see here. Sales for desired profit quantity is equals to, you know, break-even point formula, right? Break-even point is equals to, what is the formula? Fixed cost divided by fixed cost divided by contribution per unit, right? So this is the formula. For quantity, what is the formula? Fixed cost divided by contribution per unit. For this, we need to add extra one component. What is that component? Desired profit. This is the extra component we have to add. That's all. Okay, na? Next. Here, what will be the formula? Fixed cost divided by fixed cost plus desired profit divided by contribution into sales. Fixed cost divided by fixed cost plus desired profit divided by contribution into sales. Again, mathematics is permitting us to derive more number of formulas. So what is the formula we can write for this sales for desired profit value? Sales for desired profit quantity. Sales for DP. DP means desired profit quantity into selling price per unit. This is the formula you can write. Sales for desired profit quantity into selling price per unit. Again, here we can write one more formula. Na? What is the formula we can write for quantity? Sales for desired profit value divided by selling price per unit. Selling price per unit. Again here we can write one more formula na. Sales, if it is going to denominator, so what is the formula? It will become fixed cost plus desired profit divided by PV ratio. This is the formula. Fixed cost plus desired profit divided by PV ratio. Understood? Same as it is formulas. Wherever there is a fixed cost, just you need to add one word, that is desired profit. This will become sales for desired profit formulas. So 10 more formulas is finished. Break-even point 5 formulas, sales for desired profit 5 formulas. Next, in the break-even point, another one more formula we have. In the break-even point, another one more formula we have. The formula for is this thing. One concept here, that is cash one more formula we have, cash break even point. What do you mean by this cash break even point, ma? While calculating cash BEP, non-cash expenses such as depreciation should be excluded. Depreciation, while calculating the cash break even point, non-cash expenses such as what, ma? Depreciation should be excluded from fixed cost. So all the non-cash expenses, all the non-cash expenses. What do you mean by this non-cash expense, sir? The expenses which will not have outflow of cash. The expenses which will not have outflow of cash. Those expenses will call it as a what, ma? Non-cash expenses. So such as depreciation we should exclude from fixed cost. That will become what? Cash break-even point. Formula. Cash break-even point is equals to fixed cost minus depreciation divided by fixed cost minus depreciation divided by contribution per unit. Fixed cost minus depreciation. Fixed cost minus depreciation divided by contribution per unit. This is the formula for cash break even point. Okay. So these are the maximum possibility of break even point formulas which is useful for us in the future. Next concept do we have is margin of safety. What do you mean by this margin of safety? It represents the difference between actual sales and break-even sales. It represents the difference between what, ma? It represents the difference between actual sales and break-even sales. That we will call it as a margin of safety. Let us assume this is a sales line. Let us assume this is a sales line. Now this is a break-even point. Okay, what is that? That is a break-even point. So this point we are calling it as a break-even point. Okay, under this break-even point, what is the units we got? 500 units we got. In the present example, how many units we took example? Break-even point 500 units. Now actual sales Let us assume actual sales somewhere here. This is actual sales is equals to 600 units. Let us assume this is the actual sales, and actual sales is how many units? 600 units. The region which is located between these 2 points, that is only called as what? Margin of safety. The region which is located between these 2 points is called as what? Margin of safety. Margin of safety is difference between actual sales and break-even sales. Now here margin of safety is equals to how many units? Actual sales is 600, break-even is 500. So margin of safety is 100 units. Means you are safer. Your business is safer by how many units? 100 units. Means above break-even point. Whatever the sales, above break-even point, whatever the sales happens, that is complete margin of safety only. In the case of margin of safety, we are having two types of formula. One is on the basis of quantity, one is on the basis of value. Okay, na? One is on the basis of quantity, another one is on the basis of value. So on the basis of these two things, we have the formula. Let us see the formula for margin of safety. Margin of safety quantity is equals to, what is the formula? Margin of safety quantity is equals to, what is the formula? Actual sales quantity minus break-even sales quantity. Actual sales quantity minus break-even sales quantity. That is called as a what? Margin of safety. Here margin of safety value is equals to, what is the formula? Actual sales value minus break-even sales value. Actual sales value minus break-even sales value. That is called as what? That is called as a margin of safety. Next, again mathematics is permitting us to derive more number of formulas here. We can write like this now. Margin of safety is equals to, margin of safety quantity into selling price per unit. Can I write like this? Margin of safety quantity into selling price per unit. I can write like this now. Again, here I can write like this now. Margin of safety value divided by selling price per unit. I can write like this now. Why? Because margin of safety, keep it like this. Selling price per unit, if you are sending left hand side, it will go under denominator. Okay na? Next, here another one more formula we can write for margin of safety. So what is that formula? Let us calculate first. So in the given question, particulars, break-even point is how many units? 500 units. Actual sales is how many units? 600 units. Let us see how much profit will be there. Selling price. Here it is 50,000. Here it is 60,000. Minus variable cost. Here 8 5 are 40,000. Here 48,000. Contribution. Here it is 10,000. Here it is 12,000. Minus fixed cost. Here it is 10,000 fixed cost. Here also it is 10,000. That is nothing but profit. Here it is 0. Here it is how much? 2,000. Here it is how much? 2,000. Now if you see here, the difference between these two, that is called as a what? Margin of safety quantity. And the difference between these two is called what? Margin of safety value. And this is called as what? Margin of safety profit. So margin of safety quantity is equals to how many units? 100 units quantity is equals to. Margin of safety value is equals to how much? 10,000 rupees. Margin of safety profit is equals to how much? 2,000 rupees. Margin of safety profit is equals to 2000 rupees ma. Okay. Now we got the margin of safety quantity, we got margin of safety quantity, we got margin of safety value, we got, and margin of safety profit also we got, Nana. Now the formula here is net profit. What is the net profit? Take the calculators. Net profit is how much? 2000 divided by net profit divided by what is the PV ratio we calculated last? 20%, right? 0.20. 2000 by 20%, that is nothing but how much? 10,000. Means you are getting margin of safety value. See here, what is the margin of safety value? 10,000. So that is nothing but what is the formula we can write? The formula we can write here is net profit divided by PV ratio. Net profit divided by PV ratio. This is the formula for margin of safety value. Understood ma? Again, here again there is a one universal formula ma. What is the universal formula do we have here? The universal formula do we have here is margin of safety percentage plus break even point percentage is equals to sales. Sales is equals to what? Break even point plus margin of safety. Sales is equals to what? Margin of safety plus break even point. See here, what is the margin of safety at 600 units? See, what is the margin of safety? 10,000. What is the break even point? 50,000. 10,000 plus 50,000, 60,000. See here, 500 units. 500 units, what is the sales value? 50,000. So sales value is 50 means what is the margin of safety at 50,000? 0. Margin of safety at 50,000 is 0. Margin of safety is 0. What is the break even point? 50,000. So sales is 50,000. So sales is equals to, what is the formula we can use? Margin of safety plus break even point, both together will be sales. This is another one more universal formula. Which we will use. This is another one more universal formula we will use. There are two universal formula. Okay na? PV ratio plus variable cost ratio is equals to 1. Margin of safety plus break even point is also is equals to 1, or sales. Anything we can write. So these are the two formulas which we will use ma. Okay. Next concept do we have here is angle of incidence. So what do you mean by this angle of incidence? Okay na? When total cost line and sales line are plotted on a graph paper, when the total cost line and sales line are plotted on a graph paper, point of intersection between these two lines is known as break even point. The intersection between these two lines is known as what? Break even point. And one angle is formed at this point, of intersection. It is known as AOI, angle of incidence. Okay na? It is known as what ma? Angle of incidence. When we are plotting the total cost line and sales line on a graph paper, Nana, the point of intersection between these two lines is called break even point. At this break even point, one angle will be formed, that is called as the angle of incidence. So let us plot a graph paper, Nana. Okay na? Let us assume this is x-axis. I think everyone know graph paper. This is y-axis. This is x-axis, this is y-axis, and this point will call origin. This point will call origin. Let us plot revenue on x-axis. Let us plot units on x-axis. Let us plot the units on x-axis and revenue on y-axis. Let us plot the units on x-axis and revenue on y-axis. Okay now, let us think this is 100, 200, 300, 400 units. 100, 200, 300, 400 units. 10,000, 20,000, 30,000, 40,000. Okay now let us assume that is revenue and this is units which we are plotting on x-axis. Now let us see sales. When 0 units, when sales is 0 units, what is the sales revenue? 0. When it is 100 units, then the selling price per unit is 100. Selling price per unit is 100. When the units is 100, sales value will be 10,000. When units is 200, sales value will be 20,000. When units is 300, sales value will be 30,000. When units is 400, sales value will be 40,000. That is nothing but number of units increases, sales revenue is also increasing. Correct. So if you are plotting, the line will start from like this. It will start from the point of origin and it will go like this. This is called as a which line ma? Sales line. Sales line will start from 0 and it will keep on increasing. Means when the number of units are increasing, the sales revenue also will increase. Nana. Next, let us assume fixed cost is 20,000. Let us assume fixed cost is how much? 20,000. Fixed cost is 20,000. When you are selling 0 units, what is your fixed cost? 20,000. When you are selling 100 units, what is your fixed cost? 20,000 only. When you are selling 200 units, still fixed cost is 20,000. When you are selling 300 units, still fixed cost will be 20,000. When you are selling 400 units, still fixed cost will be 20,000. We know the definition of fixed cost is a cost which remains constant irrespective of the production capacity. So here the fixed cost line will be which line ma? Straight line. The fixed cost line will be a straight line. This line will call it as fixed cost line. Okay na? This cost is line, this line is known as which cost line? Fixed cost line. Next, total cost line. Nana, total cost. See here, when we are selling 0 units, when we are selling how many units? 0 units. What is our total cost? We know the formula for total cost, right? Total cost is equals to fixed cost plus variable cost. Fixed cost is how much? 20,000 plus 0 units means variable cost is 0. Means at 0 units also, what will be our fixed cost? Na? Fixed cost will be 20,000. Means if you are selling 0 units also, what will be our fixed cost? 20,000. Means fixed cost line will start from here. Fixed cost line will start from here. Okay na? So now let us draw the fixed cost line ma. Fixed cost line will start from here and it will move like this. This line we will call it as a, okay na? This line will call it as a which line ma? Total cost line, not fixed cost, total cost line. Total cost line will start from 20,000 and will move upward direction. If you are selling 0 units also, if the number of units sold is 0 also, still the total cost line will start from here only. The point of intersection between these two lines, the point of intersection between these two lines, this point of intersection is called as what ma? Break even point. Okay na? This point of intersection is called as break even point ma here. Okay na? Next, one angle is formed here. You can see this angle which I am shading with color. Here one angle is formed. This angle which I am shaded, that angle is called as angle of incidence. That angle is called as a what ma? Angle of incidence. Okay na? So this is the concept of angle of incidence nana. When the total cost line and total sales line, when they are plotted on a graph paper, the intersection between these 2 points is called as a break-even point. And when these 2 lines are intersected, one angle is formed. That angle which is formed here, will call it as a what ma? Angle of incidence nana. Okay na? So this is the angle of incidence now. This is the angle of incidence. In the examination, the question they will ask is, if angle of incidence increases, profit also will increase. Why? Because this is a break-even point. From the break-even point, if you are moving towards upper zone, that is profits. From the break-even point, if you are moving lower zone, that will be a losses. Means this zone will be profit zone. This zone will be losses zone. Okay na? So if the angle of incidence increases, profit also will increase. If the angle of incidence decreases, profit also will decrease. Okay na? In the exam they will ask, if angle of incidence increases, if the angle of incidence increases, what is the effect on PV ratio? What is the effect on PV ratio? If angle of incidence increases, what will increase nana? Profit will increase. If profit increases, automatically what will increase nana? Contribution also will increase. If contribution increases, automatically PV ratio will increase. So what is the relationship nana? Angle of incidence increases, PV ratio also will increase. Okay na? Angle of incidence decreases, PV ratio also will decrease. So this is the relationship here. If angle of incidence increases, PV ratio will increase. If the angle of incidence decreases, PV ratio will decrease. So this is the relationship nana, between the angle of incidence and PV ratio. Got it, my everyone? The relationship between angle of incidence and PV ratio. So this is the concept of angle of incidence. Now let us move on to the once ICMA material nana. Let us once go through ICMA material, then we can start with the questions ma. Okay na? Topic number 6.1.1, definition. They gave the marginal cost definition nana. Okay na? Marginal cost, there is a lot of depreciation nana. We can write any one definition. Fully absorbed product cost include fixed overhead, whereas marginal cost of a product usually consists of variable cost only. You can see here. Definition of marginal cost, what he is saying? Marginal cost of a product usually consists of variable cost only. It is defined as change in the aggregate cost due to the change in the volume of production by 1 unit. Means if there is a change in the 1 unit, what is the extra cost which is incurred for producing 1 unit? That is only called as marginal cost nana. Okay na? Next, marginal production cost of per unit of an item consists of the following items. Variable cost consists of what nana? We know that already. Variable cost consists of direct material, direct labor, variable production overheads. These 3 things together, it is called as a what nana? Variable cost. Variable cost means direct material, direct labor, variable production overheads. These 3 things are included. Next nana, marginal costing. What do you mean by marginal costing? Marginal costing is an alternative method of costing where only variable costs are charged as a cost of sale and a contribution is calculated. Okay na? Marginal costing is a alternative method of costing nana, where costs are charged as a cost of sale and a contribution is also calculated nana. Okay na? Next, he will give examples nana. Next, he is giving contribution definite, which is already be discussed. Same thing you can write nana. Contribution, same thing which you can write. Sales minus variable cost he gave. Next, what are the features of marginal costing nana? There is a possibility that they can ask in the examination for theory question. Okay, there is a possibility that they can ask in the examination for what ma? Theory question. Marginal costing. First feature nana, simple costing method. Marginal costing is a very simple costing method. And why? Because calculation of marginal cost is very easy. Marginal costing is relatively simple compared to absorption costing method. There is two methods for costing. One is a marginal costing method, one is absorption costing method. Under marginal costing method, we will consider only variable cost, whereas in the case of absorption costing, we will consider both variable cost and fixed cost. Okay. So in the case of marginal costing, we will consider only variable cost, whereas in the case of absorption costing, we will consider both fixed cost and variable cost. Marginal costing is relatively simple as compared to absorption costing because it does not involve allocating fixed overhead cost to the products. Because in the marginal costing, it does not involve allocating fixed overhead cost to the products. Do you remember while teaching the PV ratio relationship, I told you fixed cost is a cost is ignored in marginal costing and it does not play any key role for decision making purposes. It does not make any key role. It does not make any key role for decision making purposes. Next, second feature of marginal costing. Avoidance of arbitrary cost allocation. Unlike absorption costing, marginal costing avoids the arbitrary allocation of fixed overheads to the cost of products, which can distort the product cost and profitability analysis, especially in the situations of fluctuating production levels. So, avoidance of arbitrary cost allocation means here in the case of marginal costing, we can see fixed cost will be treated as a what? Fixed cost is completely ignored. There is no concept of treating fixed cost as a period cost which can be carried forward to next year. All this kind of headache is not there in the case of marginal costing. Simply fixed cost we are ignoring. That's all. That is the reason. That is one feature. Variable cost only, same thing he will repeat. Marginal cost includes only variable cost for manufacturing cost. Okay. Next, contribution margin will get. Marginal costing mainly focus on the concept of what? It mainly focuses on the concept of contribution margin. Why? Because everything is dependent on contribution in this chapter. That is the reason mainly the marginal costing focuses on what? Concept of contribution margin. Decision making purpose, yes. Marginal costing is a short term tool. It is used as a short term tool for decision making purposes. Next, reporting format. The format of marginal costing is income statement, and already we did sales minus variable cost, contribution minus fixed cost, profit or loss. That is only the format. The format of the marginal costing is income statement, which is very easy. We are categorizing them into fixed cost one category, variable cost another category. Internal reporting. Marginal costing is used only for internal reporting purpose, not for external purpose. So, marginal costing is used only for internal purpose. They will provide the information to the managers regarding different departments or different segments in order to make decisions by the managers. Okay. So, these are the features of marginal costing. These are the basic major features of marginal costing. What are the features? One is simple calculation. One is avoidance of arbitrary cost allocation. That is nothing but there is no fighting of fixed cost here. Third one is only it will consider variable cost. Mainly it focuses on the concept of contribution margin. It is a short term tool used for decision making purposes. The format, the reporting format of marginal costing is income statement, where typically it will separate fixed cost as a one category and variable cost as another category. And this marginal costing is often used for internal reporting purposes for decision making. Okay. So these are the advantages of marginal costing. Next, difference between absorption costing versus marginal costing. This is also very important for theoretical purpose. Theory question they can ask in the exam. Okay, na? What is the difference between marginal costing and absorption costing? What are the differences? Under marginal costing, only variable manufacturing cost is considered. Under marginal costing, what is considered? Under the marginal costing, only variable fixed cost is considered. Variable manufacturing cost is considered under marginal costing. Under absorption costing, both variable and fixed. both variable and fixed manufacturing costs are included under absorption costing. Next, treatment of fixed cost. Fixed manufacturing costs are treated as a period and are not allocated to the products. Here, in the case of marginal costing, fixed costs are treated as a period cost and are not allocated to the products only. Here we are not allocating to the products at all. But whereas in the case of absorption costing, fixed manufacturing cost costs are allocated here. Okay na? Here in the case of marginal it is ignored, whereas in the case of absorption it is allocated. Under marginal costing, income statements classify them into two categories. One is fixed, another one is variable category. Okay na? Under marginal costing they are categorizing into two categories. One is fixed, one is variable. Under absorption costing, absorbs all the manufacturing cost into the cost of goods sold, including fixed overheads. Reporting format here, income statement will use contribution, mainly focuses on contribution margin. Here includes full absorption of all the production cost. Nana. Here we will focus only on contribution, it will absorb on full production cost. Nana. It is a short term tool for decision making. It is a long term tool. Nana. Next, focuses on contribution to covering fixed cost and generating profit. In the case of marginal costing, what they will do now, focuses mainly on contribution to cover the fixed cost to generate profit. May provide distorted performance measures due to allocation of fixed overhead cost. May provide distorted performance measures due to allocation of fixed overhead cost. So these are the differences between marginal and absorption costing. Okay na? So these are the major differences. In the case of marginal, we will consider only variable cost, but whereas in the case of absorption, we will consider both. In the case of marginal, mainly focus on contribution. There they will absorb all the cost. It is a short term and that is a long term. Here mainly focus on contribution margin. They mainly focus on fully absorption of cost. Okay na? Like that. These are the major differences between marginal costing and absorption. Next, the impact on the profit under two cost accounting systems may be summarized as follows. Okay na? So when we are preparing the income statement, when we are calculating the profit by using marginal costing statement and absorption costing statement, so what is the impact it will have? Very important for MCQ. Nana. Frequently he will ask for MCQ questions. Scenario 1, Nana. Scenario 1, when there is no opening stock and no closing stock. Nana. When there is no opening and when there is no closing. In this situation, profit or loss under absorption and marginal costing will be equal. Okay na? In this situation, profit or loss under absorption costing and marginal costing will be what ma? Equal. Scenario 2. Value of opening stock is equals to value of closing stock, means opening stock and closing stock values are equal. Then under this situation also, the profit or loss will be equal. Nana. The profit or loss will be under these two approaches will be equal. Scenario 3, value of closing stock is more than opening stock. When the value of closing stock is more than opening stock, Nana, then in that scenario, the profit, Nana, the profit as per absorption approach will be more as compared to marginal approach. When the value of closing stock is more, Nana, then the profit as per absorption costing will be more. Next, scenario 4. When the value of opening stock is more than closing stock, Nana, then in that case, profit shown by marginal costing will be more, Nana. Okay. If closing stock is more, then profit as per absorption will be more. Opening stock is more, then the profit as per marginal costing will be more, Nana. Next, they gave income statement format as per absorption costing. As per absorption costing, they gave income statement format. Sales, we have to take it as A. Sales, we have to take it as A. Then we have to calculate total cost by using cost sheet. Direct material consumed, direct labor cost, variable manufacturing overheads, fixed manufacturing overheads. If you add all these things, the resultant figure is cost of production. We need to add opening stock of finished goods less closing stock of finished goods, then the resultant figure is COGS. Add over or under absorption, add administration cost, selling and distribution cost, then the resultant figure is what, nana? Total cost. This is treated as A. Profit is equals to A minus B. This is absorption costing, nana. This is absorption costing. We know same as it is like cost sheet only. The difference is what? This is fixed manufacturing overheads will be here, and under or over absorption of overheads will be there. Only these two things are extra. Remaining everything we already know. We know closing stock of finished goods, if the value is not given, on what basis will calculate? Cost sheet already we studied under many questions. If the closing stock of finished goods value is not given, it is always calculated on cost of production. Okay, na? So this is the format for absorption costing, nana, income statement. Next, income statement marginal costing, nana. Income statement marginal costing, first one is sales, nana. From the sales we have to minus variable cost, then you will get cost of goods. Sales also here we have to treat it as A. Sales also we have to treat it as A. Then we have to calculate variable cost, nana. Then we have to calculate variable cost. Okay, na? Variable manufacturing cost, if you calculate, then the resultant figure is what, nana? Cost of goods produced. For that, add opening stock of finished goods less closing stock, the resultant figure is cost of goods sold. Add variable administration, variable selling and distribution overheads, then the resultant figure is total variable cost. This we have to treat it as B. A minus B is equals to contribution. From the contribution, if you minus fixed cost, then the resultant figure will be net profit. What is the difference between income statement absorption costing and this? In the absorption costing, we are considering fixed manufacturing overheads, whereas in the case of marginal, you see, we are not considering fixed. That is the difference. That is the difference. Nothing else. Nothing else. Okay, na? There it is sales minus total cost. Here sales minus variable cost is contribution. Contribution minus fixed cost is profit. Only that is the difference, nana. Okay, na? Next, fundamental principle of marginal costing already we studied, nana, by using PV ratio effect already we studied. Next, nana, differential cost analysis. This is a very small concept, nana. Differential cost. What is the meaning of differential cost, sir? Differential cost is nothing but the difference between current level of activity cost and its previous level activity cost. Difference between current level of activity cost and its previous level activity cost. That we will call it as a differential cost. Differential cost means what? Difference between current level of activity cost. Difference between current level of activity cost and its previous level of activity cost, that is called as a differential cost. Examples are, suppose they give 60%, they give 70%. Okay, na? Total cost 60% is 6,000, 70% is 7,000. What do you mean by differential cost? Differential cost means change in current level of activity cost compared with previous level. So current level of activity cost is 7,000, previous level 6,000. So difference between these two is how much? 1,000 rupees. That is only called as differential cost. Differential cost is equals to 7,000 minus 6,000. How much? 1,000 rupees. This is called as a differential cost, nana. Okay, na? Differential cost represents the algebraic difference between the relevant cost for the alternatives being considered. Okay, na? That is called as a differential cost. Next, essential features. These things just you can ignore, not required. Next, nana. This concept, features and all, it is not required, and it's a very small concept. Sometimes they may ask, sometimes they may not even ask also, nana. Okay, very few chances, very few chances. This is not that much important. Next, nana, limitations of marginal costing, nana, important theory question. There is a possibility that they can ask in the theory question, nana. Limitations of marginal costing. The break-even analysis assumes that cost and revenue behavior patterns are known, that a change in the activity levels can be represented by a straight line. Okay, na? So what they are saying, nana, the break-even analysis assumes that the cost and revenue behavior patterns are known. Means break even point is nothing but what, Nana? Break even point is a point where our fixed cost is equals to contribution. For calculating this fixed cost and contribution, we require revenue and we require cost. This revenue pattern and fixed revenue pattern and cost pattern both are known. That is the assumption here. That is the assumption. That is the one of the disadvantage. Why? Because sometimes it will change. Na? Those patterns will not remain constant. It may change. It may not be always feasible to split cost precisely into fixed and variable cost. In the marginal costing, we will consider only one variable cost. So it is not possible to split variable and fixed cost. The break-even analysis assumes that fixed cost remains constant. Nana. Here there will be the assumption is what in the marginal costing. So fixed cost remains constant. Break-even analysis assumes that input and output volumes are same. Nana. Yes. Next, break-even charts and simple analysis can only deal with product at a time. This break-even charts, they can deal only with a single product. And multiple products, it cannot be deal here. Okay. Na? So another one more example also you can write. This marginal costing will ignore fixed cost. It will treat as a fixed period cost like this. What are the advantages? It is there. Quite opposite of advantages is limitations. It will be there now. Okay. So these are the points which you can cover in the limitations of marginal costing. Again, CVP analysis already be finished. Nana. Okay. Na? And tools and techniques of CVP analysis also already we finished all these formulas. Nana. Break-even point also already we finished. Margin of safety is also already be finished. Nana. PV ratio, contribution to sales ratio is nothing but PV ratio. Nana. PV ratio also we finished and we saw the effect also. Nana. Different. Next is variable cost ratio also we finished. Nana. Variable cost ratio is nothing but variable cost only. Sales to earn desired profit, that is also we finished. Nana. Next, break-even analysis is also finished. Nana. I already gave you the approach, graphical method approach I gave. Nana. Okay. Na? Equation approach we don't require. The equation approach is sales is equals to total cost plus profit. That is the equation approach. Nana. Here. Next, contribution margin also we did. Contribution margin approach also we did. Next, angle of incidence also we did. Nana. Okay. Na? Non-linear, linear, that is not required. And a cash break-even point also we already covered. Nana. Next, applications of marginal costing. In which places will apply marginal costing? Now, see, Nana, applications of marginal costing. Where we will apply this marginal costing? One is cost control purpose. For what purpose will apply this marginal costing? This marginal costing is applied for the purpose of cost control. So cost control. What do you mean by this cost control? We know that. So here fixed cost is a cost which fixed cost is a cost which remains constant irrespective of the production capacity. Means when your production capacity increases, fixed cost per unit will decrease. Yes or no? When the production capacity increases, fixed cost per unit will decrease. So which level it will be there, which by using this marginal costing, which level there will be no profit, no loss, which level there will be losses, which level there will be profits. All these things will be calculated. By using these things, they will control the cost. They will control the cost of an organization. Profit planning, desired profits. Profit planning is nothing but desired profits. Key factor. Key factor is nothing but limiting factor. What do you mean by this limiting factor? Limiting factor is any factor that restricts the production capacity of an organization. Any factor which will limit, which will restrict the production capacity of an organization, that is called as a key factor. Example, shortage of raw material. Raw material shortage is a one key factor. If there is a shortage of raw material, can we produce finished products? No, right? Next, shortage of labor. If there is a shortage of labor, can we, raw material is there plenty, but the labor is not there. Can we produce the finished goods? No, right? Like that. Any factor, it can be any factor which will restrict the production capacity of an organization. That is called as a key factor, Nana. So that key factor analysis we will do here. Decision making. By using this marginal costing, they will take different decisions. Accept or reject the offer. Special order processing. Next, continue or discontinue. Shutdown. Expansion. Next, interchange of products. Like this, lot of decisions will be taken, Nana. Next, Nana. He also again repeating application of marginal costing, again he is repeating, Nana. Next, let us see the illustration number 1. Let us see the illustration number 1. Maxwell Limited produces a single product, Boost. Okay, Maxwell Limited is a company, they are producing a single product. What is that product? That product is Boost. The following figures related to the Boost for the period 21-22. They are giving the following figures which is related to the Boost for the period 21-22. See the activity level. 50% they give, 100% they give. Sales and production units, they give 50% level, that is 400, 100% level is 800. Sales, they give 50% level 8 lakhs and 100% level 16 lakhs. That is nothing but what is the selling price per unit? Selling price per unit is equals to 2000 per unit. 8 lakhs divided by 400, that is nothing but how much? 2000 per unit. Production cost, under this production cost they gave variable production cost, fixed production cost. What is the variable production cost they gave? 3,20,000. So 3,20,000 divided by 400. That is nothing but how much, Nana? 800. What is the variable production cost per unit? Variable production cost per unit is equals to 800. Next, fixed production cost, we know it remains the same, it will not change. Under selling and distribution cost, again he gave two portions. One is variable portion, another one is fixed portion. What is the variable selling cost? 1,60,000 divided by 400, that is nothing but 400. How much, Nana? 400 rupees is the variable selling cost. Okay, na? Next, fixed cost, we know fixed cost anyway remains the same. The normal level of the activity for the year is 800 units. What is the normal level of the activity, Nana, for the year? The level of the activity for the year is 800 units. Fixed costs are incurred evenly throughout the year. Fixed costs are incurred how much? Fixed costs are incurred evenly throughout the year. And actual fixed costs are the same as budgeted. And actual fixed costs are what, Nana? The same as budgeted. So actual fixed costs are what, ma? They are same as budgeted. There were no stocks of Boost at the beginning of the year. Means opening stock of finished goods is nothing, Nana. Opening stock of finished goods is 0. In the first quarter, 220 units were produced. In the first quarter, how many units are produced, ma? 220 units were produced and 160 units were sold. That is nothing but how much is the closing stock of finished goods will be there? Closing stock of finished goods is equals to 220 minus 160, that is nothing but how much, ma? 60 units. How much, ma? 60 units is the closing stock of finished goods. Okay, na? Next, required. What would be the fixed production cost absorbed by Boost? What would be the fixed production cost, he is asking. What would be the fixed production cost absorbed by the Boost if absorption costing is followed? Which method is followed, ma? If absorption costing is followed, he is asking. Okay, na? What would be the if absorption costing is followed, what would be the fixed production cost they are asking, Nana? Very simple. What is the fixed production cost they gave, Nana, here? 1,60,000. How much did they give, Nana? They gave 1,60,000. Okay, na? 1,60,000 divided by 4. 1,60,000 divided by 4 quarters. In a year there are 4 quarters, na? How much, Nana? Fixed production cost is 40,000. 1,60,000 divided by 4 quarters. That is nothing but how much, Nana? 40,000 per quarter. 40,000 divided by 1,60,000 divided by what is the units, Nana, they are producing per year? 800. 1,60,000 divided by 800 per unit is how much, Nana? 200. 200 into, in the first quarter they produced how much, Nana? 220 units. So that is nothing but how much, Nana, they observed? They observed 44,000 in the first quarter. In the first quarter, standard is 40 only. Standard is 40 only. But how much did they observe, Nana? 44,000. Let us check. Budgeted fixed production cost is how much, Nana? 1,60,000. 1,60,000 divided by 800. One unit is how much, Nana? 200. So during the first quarter, they produced how much? 220 units. 220 into 200. That is nothing but absorption is how much, Nana? 44,000. Next question number 2. What is the question number 2? They are asking, Nana. Calculate under recovery or over recovery of overheads. Simple. Observed is 44. Actual fixed production overheads is how much, Nana? 40,000 only. But observed is 44. So over recovery. How much is the over recovery of overheads, Nana? 4,000. Next. Profit for the quarter by using which statement, Nana? Absorption costing method. By using which method, Nana? Absorption costing method. First, in the absorption costing method, what is the first one, Nana? Sales revenue. What is the sales revenue? He sold 160 units into what is the selling price per unit? 2,000. Already we calculated the cost per unit, right? See here. What is the cost per unit? Selling price per unit we calculated? 2,000. He said how many number of units are sold? 160 units are sold. So 160 into 200. 2,000, sorry. 160 into 2,000. How much more? 3,20,000. That is the sales. We have to treat it as A. Here, this is not less ma. Okay. Production cost. We have to calculate which cost, ma? Production cost. Production cost, under that what will be there, Nana? Variable will be there, fixed also will be there. Variable cost, how many units we produce, Nana? 220 units. What is the variable production cost per unit? 800. That also we calculated, right? Variable production cost per unit is 100. 220 into 800. 220 into 800. How much, Nana? 1,76,000. Fixed production overheads observed. How much did we observe, Nana? 220 units into 200. That is nothing but 44,000. So 1,76,000 plus 44. How much is the production cost, Nana? 2,20,000. That 2,20,000 will be what, Nana? Cost of. Cost of production is equals to 2,20,000 plus, see here, what we have to do, Nana? Cost of production. For this cost of production, we need to add opening stock of finished goods. Here it is not less. Wow. Blunder mistakes, Nana, a lot of. We have to add closing stock, opening stock of finished goods, and we have to minus closing stock of finished goods, Nana. Okay, na? Closing stock of finished goods is how much, Nana? 60 units, right? How much is the closing stock of finished goods? 60 units. For 220 units production, how much is the cost we incurred, Nana? 2,20,000. How much did we incur, Nana, to produce 220 units? 2,20,000. What is the closing stock? 60 units is equals to how much? 60 into 2,20,000 by 220. 60 into 2,20,000 by 220. How much, Nana? 60,000. That is how he got 60,000, Nana. Okay, na? Closing stock of finished goods value he got how much, Nana? 60,000. Same calculation I showed here. Okay. For 220 units it is 2,20,000. For 60 units is how much we know. Closing stock of finished goods always will calculate on the closing, always cost of production. Next, 2,20,000 minus 60, Nana. 2,20,000 minus 60,000. How much? 1,60,000 COGS. Cost of goods sold is 1,60,000 less adjustment for over recovery of overheads. Over recovery of overheads, what we will do, Nana? We have to minus. If it is under recovery, we will add. Over recovery, we will minus. Add selling and distribution overheads. Selling and distribution overheads, how much did they give, Nana? Selling and distribution overheads 160 units. Why? Because the selling and distribution overheads is always calculated on units sold. We know, right? We did in the cost sheet also. Selling and distribution overheads is calculated on the units sold. 160 into 400 rupees per unit. Already we calculated now here. How much variable? 400 rupees, which we calculated, that we will use here. 160 into 400, how much? 64,000. Fixed overheads 2,40,000 divided by 4 quarters, that is nothing but 60. 60 plus 64, 1,24,000. 1,60,000 minus 4,000, 1,56,000. 1,56,000 plus 1,24,000. That is how much, Nana? 2,80,000. That is the cost of sales. Cost of sales is how much, ma? 2,80,000. Profit will be, sales is how much, Nana? 3,20,000 minus 2,80,000. So how much is the profit under absorption costing? 40,000, ma. Understood everyone? Understood, ma? First step is we have to take the sales. Okay, na? Next step is production cost. Under the production cost, absorption costing will consider both. We will consider variable and fixed will consider. The resultant figure will call it as a cost of production. For that, what we need to add? Na? Opening stock of finished goods. But the opening stock of finished goods is 0. Minus closing stock of finished goods, which is given. We have to calculate the value. Then the resultant figure is cost of goods sold. Then we have to do the adjustment and over recovery adjustment. Then we have to add selling and distribution overheads. And the resultant figure is what? Cost. From the total cost, sales minus total cost. The resultant figure is what, Nana? Profit. Okay, na? Next, profit for the quarter. Next one is what, Nana? Profit for the quarter by using which method, Nana? Marginal costing method. Under the marginal costing method, what is the step number 1, Nana? We have to calculate the sales revenue. That is same A. Next, this is not less, Nana. Okay, na? There is a lot of mistakes in the material. While studying, you have to study properly. So better you are taking video classes. That is the reason you will understand where is the mistakes. Production cost, na? So production cost is how much, ma? Variable cost only will consider. Under the marginal cost, we will consider only variable cost. That is the difference between absorption and variable. See here, absorption will consider both variable and fixed. But whereas in the case of marginal cost, we will consider only variable cost. 220 units into 800. How much, Nana? 1,76,000. This 1,76,000 will treat it as cost of production. Okay, na? Opening stock of finished goods is 0 minus closing stock of finished goods. This 1,76,000 is for how many units, Nana? 220 units. 1,76,000 divided by 220 into 60 units. How much, Nana? 48,000. 1,76,000 minus 48,000. How much, ma? 1,28,000. This is the COGS. For this, we need to add variable selling overheads. Variable selling overheads, how much, Nana? 64,000. So what is the total variable cost, ma? 1,92,000. Contribution is equals to sales minus variable cost. 3,20,000 Okay ma, let us solve the illustration number 2. Okay na. In the given question he is asking, you are required to draw a profit volume graph and all is not required na, and determine the break even point. So let us calculate the PV ratio and let us calculate the break even point na. These two things let us calculate for this. Okay na. Illustration number 2. Calculation of PV ratio and break even point. Calculation of PV ratio and break even point ma. Okay na. First let us calculate existing na. Existing he gave, what is the selling price he gave na? 300 minus what is the variable cost he gave na? 285. How much is the contribution na? 15 per unit. Okay. PV ratio is equals to contribution divided by sales into 100. 15 divided by 300 into 100. How much na PV ratio? 5%. Break even point is equals to fixed cost. What is the fixed cost nana? 3 lakhs divided by contribution per unit. What is the contribution per unit nana? 15. So 3 lakhs divided by 15. So break even point is equals to how many units nana? 20,000 units. Break even point quantity is equals to 20,000 units. Okay na. So we got the PV ratio, we got the break even point also nana. Next let us calculate new. Let us calculate new ma. Okay na. In the new, what is the selling price he said? Selling price he said he is going to launch at rupees 350. So selling price is increased to how much? 350 rupees per unit. And what is the variable cost he gave in the last? 330 per unit. That is contribution per unit is equals to 20 rupees. How much is the contribution per unit? 20 rupees. PV ratio is equals to contribution divided by sales into 100. Okay na? How much? 20 divided by 350 into 100. How much ma? 5.71%. This is the PV ratio. Next, break even point is equals to what is the formula? He said fixed cost has been increased to how much? 4,50,000. 4,50,000 divided by what is the contribution for 1 unit? 20 rupees. 22,500 units. Break even point is equals to how many units? 22,500 units. So PV ratio is 5.71%. So this is the existing and this is the new one. Okay na? So let's check in the answer. The graph and all it is not required. See here ma, contribution per unit is 15, here it is 20. Break even point is 20,000, here 22,500. He did not even calculated the PV ratio, but we calculated PV ratio also in the given question. Okay na? Next in the given question they calculated indifference point of sales also, nana. In the given question they calculated indifference point. Indifference point means you know, right? So differential cost is different from indifference point. Indifference point is nothing but it sales units when both the situation have equal profits. What do you mean by indifference point of sales, nana? It is a situation where at both the sales units we will have equal profits. Nana. That is only called as indifference point. He is showing here how to calculate indifference point. Let X be the unit of sales where the profit will remain same under both the situations. Let X be the units of sale where the profits will remain what? Same under both the situations. What is the contribution per unit we got? 15. 15 into X. 15 into X. We don't know units now. 15 into X minus 3 lakhs is equals to, what is the contribution per unit here? 20. 20 into units we don't know, X minus 4,50,000. While solving the equation 20X minus 15X, by solving this equation 20X minus 15X is equals to 1,50,000. X is equals to 1,50,000 divided by 5. X is equals to 30,000 units. Means at 30,000 units at 30,000 units present situation also profit will be same, and proposed situation also profit will be same at 30,000 units. That is only called as indifference point. That is only called as which point indifference point. Indifference point is the point where under both the situations profits will be same. Next, illustration number 3 okay na. The sports material manufacturing company budgeted the following data for the upcoming year. They gave the budgeted data for the upcoming year. Sales they gave 1 lakh units. Amount they gave 1 lakh. That is nothing but what is the selling price per unit Selling price per unit is equals to 1 rupee. Rupees 1 per unit. Selling price will be how much? 1 lakh by 1 lakh. That is nothing but selling price per unit will be 1 lakh. Next, variable cost 40,000 they give. So variable cost per unit will be how much? 40,000 divided by 1 lakh. That is nothing but 0.4. Okay na? And they give fixed cost. How much is the fixed cost 50,000. Okay na? Find out PV ratio, break even point and margin of safety. What is the question number 1 he is asking, nana? PV ratio, break even point and margin of safety is asking. PV ratio is equals to, what is the formula? Selling price minus variable cost. Selling price how much, nana? Selling price is 1 rupee. What is the variable cost? 0.4. And what is the contribution? 0.6. So PV ratio is equals to contribution divided by sales into 100. Contribution divided by sales into 100. They gave the sales is 1 lakh minus variable cost 40,000 and contribution is 60,000 minus fixed cost, profit is 10,000. So first question, PV ratio. PV ratio is equals to, what is the formula? Contribution divided by sales into 100. 60,000 divided by 1 lakh into 100, that is nothing but 60%. How much is the PV ratio? 60%. Next, break even sales. Break even sales is equals to, what is the formula? Fixed cost by PV ratio. We can use this formula, right? We know this break even sales value formula. Under the break even sales value, we are having 3 formulas. One is fixed cost by contribution into sales. Second one is fixed cost break even point quantity into selling price per unit. Third one is fixed cost by PV ratio. Out of these 3, which one is easy? We have fixed cost and we have PV ratio. Directly we can use this formula now. So fixed cost by PV ratio. So how much is the break even sales? 83,000. Margin of safety is equals to total sales minus break even sales. What is the total sales? 1 lakh. What is the break even sales? 83,000. So that is nothing but, what is the profit? Profit is 16,667. 50,000 divided by 0.6. This is not 83,000 ma. This is 83,333. 83,333. Okay na? And what is the margin of safety ma? Margin of safety is equals to total sales minus break even sales. Okay na? So this is how we will calculate ma. This is how we will calculate. Next, let us see the remaining part question. Evaluate the effect of 20% increase in the physical sales volume. How much is the sales volume increase? 20% increase in the physical sales volume, he is saying. Already we know, right? We did the relationship. If the sales volume increases or decreases, still PV ratio remains the same. PV ratio is same. For this also, PV ratio is same. Okay na? That is what he will do. Let us see. Already we did this ratio, right? This relationship we did. Again, no required, but still they will do. Let us see. Increase in the volume by 20%. Nana. Increase in the volume by 20% means sales quantity is how much? 1,20,000. 1,20,000 into 1. So sales quantity, how much is the sales quantity? 1,20,000. Increase in the sales volume by 20% means sales quantity is 1,20,000. 1,20,000 into 1,20,000. 1,20,000 into 1, 1,20,000 minus 1,20,000 into 4, 48,000. Contribution is 72,000. 72,000 divided by 1,20,000 into 100. How much is the PV ratio? 60%. So PV ratio is same. There is no difference. Next, break even point. Fixed cost by PV ratio. Again, break even sales also same. Margin of safety is different. Margin of safety will be different. It will increase. Why? Because sales is increasing. That is the reason margin of safety will increase. Okay. PV ratio is same, break even sales also same, but margin of safety increases. But margin of safety increases. Why? Because sales increased, margin of safety is increasing. Next, decrease in volume by 20%, still there is no effect. See here, volume, how much base is? 1 lakh, 1 lakh minus 20%. Here, base is 1 lakh plus 20% they did. That is nothing but 1,20,000. Here 1 lakh minus 20%, that is nothing but 80,000. How much more? 80,000. So 80,000 into 1, 80,000 minus 80,000 into 4, 32,000 minus, that is nothing but contribution is 48,000. 48,000 divided by 80,000 into 100, that is nothing but how much more? 60%. That is nothing but 60%. So PV ratio is same, break even point also same, but margin of safety decreases. Margin of safety is 80,000 minus 83,333. That is nothing but it's going under loss. It's going under loss. 3,333 loss. Why? Because break even point is more, sales is less. Okay. So for this, PV ratio is same, break even sales also same, but margin of safety is going down. Margin of safety is going down if the decrease in sales volume. Third question, 5% increase in variable cost. Only increase in which cost? Variable cost. So 5% increase in variable cost. Sales is 1 lakh. 1 lakh into, before what is the variable cost? In the given question we found. What is the variable cost? 0.40. 0.40 into 105%, that is nothing but 0.42. How much is the variable cost? 0.42. 1 lakh into 0.42, that is nothing but 42,000. How much is the contribution? 58,000. 58,000 divided by 1 lakh, that is nothing but 58%. Again, break even point 86,207 and the margin of safety is 13,793. Okay, means here when the variable cost is increasing, PV ratio decreases. PV ratio decreases. Why? Because before it is 60, now it is 58%. Next, break even point increases. Break even point increases and margin of safety decreases. Break even point is increasing and margin of safety is decreasing. Okay na? PV ratio is decreasing means break even point is increasing. If the break even point is increasing means margin of safety is decreasing. Next, 5% decrease in variable cost, that is nothing but 0.40 into 95%. 0.38. 1 lakh into 0.38 is 38,000. So how much is the contribution? 62,000. 62,000 by 1 lakh into 62%. Break even 80,000. Margin of safety 19,000. Means when the variable cost is decreasing, PV ratio is increasing and a break even point decreasing. Margin of safety increasing. Okay na? So when the variable cost is decreasing, Nana, when the variable cost is decreasing, PV ratio, what is the effect on PV ratio? Nana? PV ratio increases and break even point decreases. Break even point decreases and margin of safety increases, Nana. So this is the effect here. This is the effect. Okay na? Next, fifth one, 10% increase in fixed cost. Already we know, we did this relationship. If the fixed cost increases or decreases, still they don't have any effect on PV ratio. Now, still they don't have any effect on PV ratio. See here PV ratio remains the same. Here also it remains the same. 10% increase, 10% decrease. 10% increase in the fixed cost, he said. What is the fixed cost before? 50,000, right? 50,000 into 110%. So what is the new fixed cost? 55,000. 55,000 by 60%, 91,000. Means when the fixed cost increases, break even point also increasing. When the break even point increases, margin of safety will decrease. Margin of safety will decrease. Now, when break even is increasing, our profit margin will decrease. So margin of safety decreases. Next, decrease in fixed cost, 50,000 into 90%. That is nothing but 45,000. How much more? 45,000. 45,000 by 60%. So when the decrease in fixed cost, when there is a decrease in the fixed cost, break even point decreases. Why? Because burden is decreasing. When the fixed cost is decreasing, break even point burden is decreasing. When the break even point burden is decreasing, margin of safety will increase. Our margin of safety will increase, Nana. Next, seventh one, 10% decrease in selling price and 10% increase in sales volume. Okay na? So selling price is decreased by how much? 10%. That is nothing but selling price is 0.90. And increase in volume 10%, that is nothing but quantity is equals to 1,10,000. Quantity is equals to 1,10,000 and selling price is equals to 0.9090 paisa. Okay na? So 1,10,000 into 0.9, that is nothing but 99,000. 1,10,000 into 0.4, 44,000. How much is the contribution? 55,000. 55,000 divided by 99,000 into 100. So that is nothing but a PV ratio decreased here. When the PV ratio is decreasing, break even point increases. When the break even point increases, margin of safety decreases. That is the relationship, Nana. That is the relationship. When PV ratio is decreasing, automatically what will increase, ma? Break even point will increase. When the break even point increases, again effect on MOS decreases. Next, 10% increase in selling price and 10% decrease in sales volume. That means selling price is equals to 1.1, quantity is equals to 90,000. Quantity is equals to how much more? 90,000. Selling price is 1.1, 90,000 into 1.1, that is nothing but how much more? 99,000. 99,000 plus variable cost. How much is the variable cost more? 90,000 into 0.4. How much more? 36,000. 99,000 minus 36,000. How much more? 63,000. Contribution is 63. 63 by 99 is 63.33. That is nothing but PV ratio is increasing here. When the PV ratio increases, break even point decreases. When the break even point decreases, margin of safety increases. That's all. Here, 5,000 variable cost decrease accompanied by 15,000 increase in fixed cost. Okay na? Variable cost decreased by 5k, fixed cost increased by 15k. Variable cost is decreased by 5k. Okay na? Variable cost is decreased by how much, Nana? variable cost is decreased by 5k and fixed cost is increased by 15k nana. Okay, so sales is 1 lakh, same variable cost he said 5,000 rupees na, so 40,000 minus 5,000 directly 35,000, so contribution is 65 is nothing but margin of safety increases. Okay na, but here again fixed cost is increasing. If the PV ratio is increasing, sir, not margin of safety, PV ratio increases, break even should decrease, but here accompanied fixed cost increase in na, again break even point also increasing, then margin of safety will automatically decrease. Margin of safety will automatically decrease nana if break even point increases. Here finally we can tell one thing nana, in this whole, after observing all these things, already we know on PV ratio, but we can say relationship between PV ratio and break even point nana. We can say relationship between what? PV ratio and break even point. See here, note. Okay na? If PV ratio increases, break even point decreases. If PV ratio increases, break even point decreases nana. Okay na? And if PV ratio decreases, break even point increases. This you have to keep a note nana. Why? Because all these questions they will ask in the MCQ. Okay na? So all these questions they will ask in the MCQ nana. Important. Okay. If PV ratio increases, break even point decreases nana. Again PV ratio decreases, break even point will increase. Okay na? Next, another one more note we can write here down. If break even point increases, see here, if the break even point is increasing, margin of safety decreases and break even point decreases, margin of safety will increase. Okay. This is the point which you have to keep in your mind. If break even point increases, margin of safety is decreasing, and break even point decreases, margin of safety is increasing. Why? Because you have to understand the logics nana here. You have to understand the logics. When the PV ratio is increasing, it is in the denominator, right? That is the reason break even point is coming down. That is the reason break even point is coming down. See here. When the PV ratio is 63.63, you see the break even point 78,759. It's come down now. Why? Because the burden, decreasing burden will come down. Why? PV ratio increases means our profit margin will increase. Then slowly our reaching point, fixed cost burden will come down. Next, here you see break even point increases, margin of safety will come down. See here. When the break even point is increased here, it is 90,000 almost all, correct? Our profit has come down to how much margin of safety? 8,991, like that. Okay na? Next, illustration number 4. Two businesses AB Limited and CD Limited are sell the same type of product in the same market. Two businesses AB Limited and CD Limited, they sell the same type of product in the same market nana. Their budgeted profits and loss accounts for the year ending 30th June 2021 are as follows. So AB Limited is a one company, CD Limited is a one company nana. They are selling same in the market, they are selling same products nana. Okay. Sales they gave 1,50,000, CD Limited also same. Variable cost here it is 1,20,000, there it is 1 lakh. Fixed cost here it is 15,000, there it is 35,000, and final profit is same. Okay, you are required to calculate the break even point of each business and state which business is likely to earn greater profits in the following conditions. He is asking us to calculate the break-even point of each business, Nana, and he is asking which business is likely to earn greater profits in the following conditions. Okay, na? When there is a heavy demand for the product. When there is a which demand, Nana? When there is a heavy demand for the product, then which one is good, better? Which company is better? When there is a low demand for the product, which one is better, Nana? Okay, na? Simple. When there is a heavy demand for the product, both are getting same profit, na? Both are selling same product, na? When they are selling same when there is a heavy demand for the product, na? Simple. How we have to decide? We have to decide on the basis of PV ratio or contribution. Contribution which gives highest, that is better to sell. When there is a heavy demand for the product, contribution which gives highest, that is better to sell. Then how, sir? Simple, I will tell you. You have a provision store. You are selling two types of soaps. Okay, na? One soap he is selling Lifebuoy, another soap you are selling Santur. One is Lifebuoy, one is Santur soap. Lifebuoy is also heavy demand, Santur is also having heavy demand, Nana. Then which one will you recommend to the customer? Which one you will recommend to the customer? The soap which gives highest profit, right? The soap which gives you highest profit. Suppose the profit is 5 rupees for Santur soap and the profit is 10 rupees for Lifebuoy soap. If some customer is coming to the shop and asking, give me one soap, which soap you will give, Santur or Lifebuoy? Definitely you will give Lifebuoy only. Why? Because the profit margin is higher in that soap. Like that. So contribution which gives highest, that will choose. When there is a low demand for the product, Nana. Low demand means what? When sales is very tough. Then when the sales is tough, what we have to see? We have to see break-even point which is lowest. That is easy to achieve. Break-even point which gives lower. The break-even point which is having lowest, that is easy to approach, Nana. Okay, na? So then when there is a heavy demand, contribution which gives highest. When there is a low demand, break-even point which gives lowest. Now let us calculate the contribution and break-even point. Then we can decide which is option A, which is option B, Nana. AB limited, CD limited. Okay, na? I hope everything is done here already. Instead of doing, we can see the same calculation here. Statement showing computation of PV ratio, break-even point and determination of profitability in different. Sales 1,50,000, variable cost, here it is 1,20,000 and here it is 1 lakh. So that is nothing but how much is the contribution? 30,000, 50,000. So the product which is giving highest contribution is what? 50,000. So the answer is when there is a heavy demand, we have to choose CD limited. Why? Because it is having highest contribution. Next, minus 15,000, profit is 15,000, Nana. Here also 50,000 minus 35,000, profit is 15,000. Same both the conditions. Okay, na? Next he calculated PV ratio. PV ratio is equals to 30,000 divided by, contribution is 30,000 divided by 1,50,000 into 100, that is nothing but 20%. There it is 50,000 by 1,50,000 into 100, that is nothing but 33.33%. Next, fixed cost, break-even sales is equals to fixed cost by PV ratio. Fixed cost is 15,000 here, 15,000 by PV ratio, that is nothing but 0.20. How much, Nana? 75,000 rupees break-even point. Here, fixed cost is 35,000 divided by 0.333. So that is nothing but how much, Nana? 1,05,000. So when there is a low demand for the product, break-even point which gives lower. Which is lower here? Break-even point AB limited. So the answer will be what, Nana? AB limited. Okay, na? When there is a heavy demand for the product, CD limited. When there is a low demand for the product, AB limited. Why? Because it is very easy to achieve. Because break-even point is a point, means in order to AB limited, if you are selling 75,000 rupees only, you will reach no profit, no loss. But whereas CD limited, to reach no profit, no loss zone, you have to sell 1,05,000. Which one is easy? 75,000 selling is easier, 1,05,000 is easier, 75,000 is easy. That is the reason when there is a low demand, AB limited. When there is a heavy demand, CD limited. Same thing. See here. When there is a heavy demand for the product, CD Limited is profitable because the PB ratio is higher than AB Limited. When there is a low demand for the product, AB Limited is profitable. Understood, my everyone? So this is how we have to calculate when there is a heavy and low demand. Next, illustration number 5. A factory is currently working to 40% capacity. A factory is currently working to how much capacity? 40% capacity, and produces 10,000 units. At 40% capacity, they are producing 10,000 units. At 50% capacity, the selling price falls by 3%. At 50% capacity, what is the selling price, Nana? Selling price is falling by 3%. Okay. At 90% capacity, selling price falls by 5%, accompanied by similar fall in the price of raw material. Okay, na? So at 90% capacity, what he is selling? Selling price falls by 5%, accompanied means together there is a fall in the price of raw material also. So selling price also decreasing 5% and raw material also decreasing 5%. Estimate the profits of the company at 50% at 90% capacity production. So he is asking us to estimate the profits of the company at 50% production and at 90% capacity production. The cost at present is material 10 rupees, labor 3 rupees, overheads rupees 5, 60% fixed, means 40% variable. Selling price per unit is 20 rupees per unit. What is the selling price per unit? 20 rupees per unit. So this is the given thing. Okay. So let us prepare the budget now. Okay. Now this question is a combination of marginal costing plus budget and budgetary control. This question is a combination of two chapters now. So let us prepare the budget at 50% and 90% capacity also now. Okay. But to prepare 50 and 90%, there is a fixed also now. Fixed cost always remains fixed for base. What is the base capacity here? 40%. What is the base capacity? 40%. So we have to prepare budget for 40 as well as we have to prepare for 40, 50 and 90% capacity. For 3 capacity levels we have to prepare. Okay. He already prepared. Same thing we can go through now. That is good only. He prepared it. The calculation part is good only. Let us go through the calculation part. Okay. See in the given question, First we have to calculate number of units. Let us calculate the number of units at 50% and 90%. At 40%, how much did they give? 10,000 units. At 40%, how many units did they give? 10,000 units. Then at 50%, it will be how much? 10,000 divided by 40 into 50. How much more? 12,500 units. Next, at 90%, it will be how much? 10,000 divided by 40 into 90. So that is nothing but 22,500 units. Okay. 40% it is 10,000, 50% it is 12,500 and 90% it is 22,500 units. Okay. Now we got the units now. Next we have to calculate fixed cost. You know, right? Fixed cost will remain fixed and it will not change irrespective of the production capacity. So fixed cost we have to calculate first for 40%. So whatever the fixed cost will calculate for 40%, it will be same for 50% also, it will be same for 90% also. Why? Because 40% is given in the question. So that is the reason that will be treated as a base. See here, 10,000 units, 12,500, 22,500 units. That is how he got. Okay. Next, selling price. Selling price is 20 only at 40%, and at 50% how much he said it will decrease by, how much percentage he said selling price will decrease by? At a 50% the selling price falls by 3%. So take the calculators. 20 minus 3% you do. 20 minus 3%, that is nothing but how much? 19.4. Okay. Next, at 90% selling price falls by how much percentage? He said 5%. 20 minus 5%, how much? 19 rupees. That is the selling price. That is the selling price. Okay. 20 into how many units? 40%. 20,000. 20 into 10,000. 20 into 10,000. That is nothing but sales. 2 lakhs. 20 into 10,000. That is nothing but sales. 2 lakhs. Next, 12,500 into 19.4. That is nothing but 2,42,500. Next, at 90%, 22,500. 22,500 into 19. That is nothing but 4,27,500. 4,27,500. That is the sales. Got it, my everyone? Minus variable cost. Variable cost, he gave cost per unit remains the same. It will not change. 10 into 10,000, 1 lakh. 10 into 12,500, 1,25,000. 10 into 22,500. So, sorry. Here material cost will fall. Here this is important. He said in the given question. In the given question, what he said? Read. At 90% capacity, the selling price falls by 5%, accompanied, means together by a similar fall in the price of material also. Okay, na? So material fall will be how much? 10 minus 5%. How much we have to take here? 9.5. 9.5 into 22,500. How much? 2,13,750. Okay, na? Labor 3 rupees. 10 into 3, 30,000. 12,500 into 3, 37,500. 22,500 into 3, 67,500. Okay, na? Labor is also finished. Variable overheads, how much did he give? 2 rupees. 2 into 10,000, 20,000. 2 into 12,500, 25,000. 2 into 22,500, 45,000. Okay, na? So this is the variable cost. Sales minus variable cost. So what will be the resultant figure? Contribution. What will be the resultant figure? Contribution. Okay, na? Sales is 2 lakhs. 2 lakhs minus 1 lakh minus 30,000. This variable overhead, did you understood, ma? 2 rupees, how it came? Because in the given question he said overheads are 60% fixed, 40% variable, na? 5 into 40%. That is how he got 2 rupees, ma. Okay, na? Minus 20,000. So how much is the contribution, ma? 50,000. Next, 242,500 minus 1,25,000 minus 37,500 minus 25,000 minus how much, ma? 55,000 is the contribution here. Next, 4,27,500 minus 2,13,750 minus 67,500 minus 45,000. So how much is the contribution, na? 1,01,250. Okay, na? Now from this we have to minus fixed cost. Fixed cost we have to calculate at which percent, na? 40%, because this is base. This is base. Okay, na? See how to calculate fixed cost at base. At 40%, see overheads he gave 5 rupees, 60% fixed. 60% fixed means fixed overheads is equals to 5 into 60%. That is nothing but 3 rupees into how many units, ma? 10,000 units. So that is nothing but how much is the fixed cost? 30,000. If it is a 40% also 30, 50% also 30, 90% also 30,000 only. So the resultant figure will be what, ma? Profit. So how much is the profit? 50 minus 20. 50 minus 30,000, and that is nothing but 20,000 is the profit. 55 minus 30, 25,000. 1,01,250 minus 30,000. 71,250 is the profit, ma. Okay. Now we got the profit. Finished. Next. Did he ask anything break even point? No, he did not ask, but he calculated break even sales. Break even sales is equals to fixed cost by contribution per unit also you can do. Fixed cost by contribution into sales also you can do. And anything we can do. Otherwise we can calculate PV ratio also. We can calculate through PV ratio also. See here I will show you through PV ratio. PV ratio is equals to what is the formula? Contribution by sales. 50,000 divided by 2 lakhs. So here PV ratio is how much? 20%. Sorry, 25%. Here 55,000 divided by 2,42,500 into 100. 22.68%. Here 1,01,250 divided by 4,27,500 into 100, that is 23.684%. Okay, we got the PV ratio. Next, if you got the PV ratio, fixed cost by PV ratio. What is the fixed cost here? 30,000 divided by 0.25. So that is nothing but how much? 30,000 divided by 0.25, 1,20,000. Next here 30,000 divided by 0.2268. 30,000 divided by 0.2268. That is nothing but 1,32,275. 1,32,275. Here 30,000 divided by 0.23684. How much that is? 1,26,668 or 1,26,667. Okay, same thing which we got. Any formula we can apply, Nana. There is no particular rule that you have to use this formula only, you have to that formula. Now use Anna. They calculated by fixed cost by contribution into selling price. They used, that is the formula. I used PV ratio formula and I calculated and I showed you. Okay, just is nothing but to fill the confidence that we can use any formula. Why I did the calculation is to prove you that we can use any formula. Final answer will be the same. That is the reason this is called techniques of costing. That is the reason this is called as a techniques of costing. Understood everyone? So this is the illustration number 5, Nana. So illustration number 5 is nothing but it's a combination of marginal costing plus budget and budgetary control. Simple question only, Nana. Okay, na? 40%. Only the thing which you have to keep in your mind is fixed cost. Fixed cost we have to always calculate for base. Here what is the base, Nana, capacity? The base capacity is 40%. That is the base capacity. Okay, na? Next, let us move on to the illustration number 6. The sales turnover and profit during the 2 periods were as follows. They gave the sales turnover and they gave the profits for the 2 periods. Nana. Okay, na? Period 1, sales which is given is how much, Nana? 2 lakhs. Profit is 20,000. Okay, na? Next, so they gave the period 1 sales, how much, ma? 2 lakhs. Profit 20,000. Period 2 sales 3 lakhs. How much is the profit? 40,000. What would be the probable trading results with sales of 1,80,000? He is asking what would be the probable trading results with the sales of 1,80,000. That is nothing but desired sales 1,80,000. What amount of sales will yield a profit of 50,000? Desired profit 50,000. Okay, first let us calculate the solution with existing. Existing, if you see, they gave the profit for 2 years and sales for 2 years. To calculate PV ratio, what is the formula we can use? Immediately you have to remember in your mind, contribution by sales, no use. We have to use another one more formula for here, PV ratio. What is the formula? Change in profit divided by change in sales. 40 minus 20 by 3 lakhs minus 2 lakhs into 100. So that is nothing but how much is the PV ratio now? They calculated already 20%. Change in profit by change in sales. 40,000 minus 20,000 is 20,000. 20,000 by 1 lakh into 100 is nothing but 20%. Okay, now. So we got the sales. So we got this, sir. We got PV ratio. Once we got the PV ratio, we can calculate which? Fixed cost. What we can calculate here? Fixed cost we can calculate. How, sir? I will show you one formula here. Okay, na? I will show you one formula here, then you will understand. We know PV ratio is equals to, what is the formula? Contribution divided by sales into 100, correct? Contribution means, can I write like this? Fixed cost plus profit divided by sales into 100. Can I write like this? Yes, no? Now cross multiply. Sales into PV ratio is equals to fixed cost plus profit. Fixed cost is equals to, what is the formula we can write? Sales into PV ratio minus profit. So this is the formula we can use. What is the formula we can use? Fixed cost is equals to sales into PV ratio minus profit. This is the formula we can use. Now by using this formula we can find out fixed cost. Let us apply in the period 1. Let us apply in the period 1 ma. Okay. Fixed cost is equals to, what is the period 1 sales? 2 lakhs. Into, what is the PV ratio? 20%. Minus, what is the period 1 profit? 20,000. So 2 lakhs into 20%, 40,000. 40,000 minus 20,000, 20,000 is the fixed cost. How much is the fixed cost? 20,000. Sir, I want to apply in period 2. Yeah, you can apply. Still, the answer remains the same. Period 2, fixed cost is equals to, sales is how much? 3 lakhs into 20%. 3 lakhs into 20% is 60,000. 60,000 minus 40,000, 20,000. So fixed cost also we got. Okay. Now what is the question he is asking? What would be the probable trading results with a sales of 1,80,000? That is nothing but desired sales. He gave desired sales is how much? 1,80,000. He is asking what is the results. Simple. We know desired sales is equals to, what is the formula? Fixed cost plus desired profit by PV ratio. We know this formula, right? 1,80,000 is equals to 20,000 plus X divided by 0.20. Cross multiply. 1,80,000 into 0.20 is equals to 20,000 plus X. That is nothing but 36,000 is equals to 20,000 plus X. X is equals to 16,000. How much? Sale, then profit when the sales is 1,80,000, profit will be 16,000. So this is the probable trading results. Next question, what he is asking? What amount of sales will yield a profit of 40,000? He is asking. Okay na? So simple. Again same formula. Desired sales is equals to fixed cost plus, what is the desired profit he is saying now? 40,000 by PV ratio 0.20. 20 plus 40, 60,000. 60,000 by 0.20. That is nothing but how much? 3 lakhs. So when the desired sales is 3 lakhs, the profit will be how much ma? 40,000. Okay na? See in the answer. Same thing he will calculate. Okay na? But he will not derive this formula, just directly he will try to apply the formula. Okay, sorry, he gave desired profit is 50,000 and not 40,000. Okay. Fixed cost of 20,000, he also got the same answer. When the proposed sales is 1,80,000, what is the profit he got? 16,000. When the desired sales, desired profit is 50,000 he gave, not 40. Here it is 50 you take. 50 plus 20, 70,000. 70,000 divided by 0.2, 3 lakhs 50,000. Same thing he also got desired sales. Okay ma, he did not wrote any formula, just he tried to solve the period 1 period 2 like that he wrote and he tried to solve. Okay, but we derived the formula by using PV ratio formula. We derived fixed cost and then we calculated fixed cost. The next we calculated the probable trading results now. Next ma, illustration number 7. See here, he is giving sales profit. Sometimes he won't give profit, he will give total cost. What you will do then? What you will do then? He won't give profit only. If he is giving profit, you are writing directly change in profit by change in sales. He is not giving profit only, he is giving total cost. Then what you will do? First you have to find out profit. How sir? Sales minus total cost is nothing but what? Profit. First you have to find out the profit for year 2020, profit for year 2021, then later you have to solve the question. Then later you have to solve the question. Understood? This is how we will do. He is giving profit here, directly you are solving, but in the exam he will not give, he will give total cost. Then what you will do? Total change in total cost by change in total sales is not, that is not the formula, right? The formula is change in profit. Profit, how it will arrive? From the sales you have to minus the cost, then we'll get profit. Be careful in the exam. The following results of a company for the last year are as follows. Okay, they gave the sales for 2020 and gave the profit also 2020. 2021 also they gave sales, they gave profit. First question they are asking PV ratio. PV ratio is equal to, what is the formula? Change in profit by change in sales. 25 minus 20, 5,000 divided by change in sales 1,70,000 minus 1,50,000, 20,000. 5,000 divided by 20,000 into 100, that is nothing but how much percentage? 25%. How much percentage? 25% ma. Okay na? PV ratio is equals to 25%. Next, break even point. Break even point is equals to, what is the formula? Fixed cost by PV ratio. But in the given question, did they give fixed cost? See here, not given, but we have to find out the fixed cost. Fixed cost is equals to, just now we derived the formula. What is the formula we derived? Sales into PV ratio minus profit. So I am writing for 2021. Fixed cost I am finding from 2021. Sales into PV ratio 25% minus profit for 2020 is 20,000. 1,50,000 into 25%, 37,500 minus 20,000, 17,500 is the fixed cost. How much is the fixed cost ma? 17,500. Break even point is equals to, fixed cost is 17,500. 17,500 by PV ratio 0.25. How much ma? 70,000 is the break even sales. Break even sales is equals to 70,000. Next question number 3. Sales required to earn a desired profit of 40,000. Desired profit of 40,000 means, desired profit means formula, what is the desired sales is equals to fixed cost 17,500 plus what is the desired profit? 40,000. Fixed cost plus desired profit divided by PV ratio 0.25. How much ma? 2,30,000. Fixed cost plus desired profit by PV ratio. Profit, when the sales are 2,50,000. When the sales are 2,50,000, he is asking how much is the profit. Nana, simple. When the sales are 2,50,000 is equals to 17,000 desired profit. Sir, fixed cost 17,500 plus desired profit by 0.25, cross multiply. 2,50,000 into 0.25 is equals to 17,500 plus x. 2,50,000 into 0.25, how much? 62,500. 62x is equals to 62,500 minus 17,500, 45,000. So what is the answer, Nana? Profit, when the sales are 2,50,000, profit is 45,000. Okay na? So profit is equals to, what is the formula he wrote? Sales into PV ratio minus fixed cost. Good. He also derived one formula. Finally, see here, we want profit na. We want to profit now. So what is the formula we can write here? Profit is equals to sales into PV ratio minus fixed cost. That is what he did. We need not to do X and all. Sales into PV ratio minus profit. If we do, directly we'll get the answer. Next, margin of safety at a profit of 50,000. He is saying margin of safety at a profit of 50,000. Margin of safety is equal to, what is the formula we know? There are three formulas: actual sales value, break even sales value. Next, margin of safety quantity into selling price per unit, net profit by PV ratio. He gave the net profit na 50,000. 50,000 divided by PV ratio 0.25. How much? 2 lakhs margin of safety. How much is the margin of safety? 2 lakhs. Next question. Variable cost of 2 periods he is asking. Oh, nice. Variable cost of 2 periods he is asking 2020, 2021. Simple. We already know PV ratio. Na? PV ratio is 25%, means variable cost ratio is how much? 75%. So 1,50,000 into 75%. How much? 1,12,500. Right? Why? Because we know the universal formula. What is the universal formula? Variable cost ratio plus PV ratio is equals to 1. By using that formula, I found PV ratio already we know. We found na 25. When the PV ratio is 25, then this will be 75. 1,70,000 into 75%. How much? Na? 1,27,500. That's all. In the group 1, these kind of questions they will ask for 10 marks. Each question carries 2 marks. Each question will carry 2 marks. These kind of questions they will ask in the exam. Okay na? Next, let us move on to the illustration number 8. The following is the statement of Radical Company for the month of June. The following is the statement of Radical Company for the month of June. They give sales, product L, product M. How much did they give? 60,000, 60,000. Total is 1,20,000. Variable cost, how much did they give? 42,000, 30,000. That is 72,000. So what is the percentage on sales variable cost? 42 divided by 60 into 100. Product L is 70%. 30 by 60, 50%. Okay. Variable cost is how much? 70% on sales, and M is 50% on sales. Sales minus variable cost is contribution. So 60 minus 42, 18. 60 minus 30, 30. So total 18 minus 38, 48. And they give fixed cost. They did not give fixed cost for product L, product M separately. Product L and product M they did not give separately. They give overall 36,000. Okay. Na? So how much is the net income? The net income is 12,000. Nice. You are required to compute PV ratio for each product. Then compute the PV ratio, break even point, net income for the following assumption also. Good. You are required to compute the PV ratio for each product. He is asking. Simple. Contribution is 18,000. 18,000 divided by 60,000 into 100. So contribution for product L is, sir, PV ratio for product L is 30%. Next 30 by 60, 50% is for M. Product M PV ratio is 50, product L is 30. And overall 48,000 divided by 120, 40%. You can see here 30%, 50%, 40%. Finished. Next, second assumption. Are Rama, there, see here, lot of things he will do. sales revenue is divided as 40% to product L and 60% to product M. Okay na? So what is the first one na? Sales revenue is divided as, okay, they did not give any number. He is correct only here. We only wrong. See, he did not give any number. That is the reason directly he calculated. Sorry. Sales revenue divided as 60% to product L nana and 40% to product M. They are dividing the sales revenue between L and M 60-40 ratio. 60-40 means what is the total sales they give? 1,20,000. 1,20,000 into 60%. 1,20,000 into 60%, 12 5 is 60, 12 6 is 72,000, 48,000. Okay na? Next, less variable cost. Variable cost you should not do into 60 into 40 ma. Some people they will do, what they will do, 72,000 into 60%, 72,000 into 40%. Directly they will multiply and they will write in flow. 60-40 they said na, 72,000 into 60%, 72,000 into 40%. That we should not do ma. Sometimes it happens, okay na, but you should not do that. Why? Already we calculated a percentage. What is the percentage on sales variable cost? 70-50. That's what we have to take here. 72,000 into 70, 48,000 into 50%. Okay na? 50,400, 24,000. So sales minus variable cost is what ma? Contribution. 21,600, 24,000. Okay na? Next we have to calculate which ratio? PV ratio. 21,600 plus 24,000. 45,600. 45,600 minus 36,000, 9,600. Okay. Now we can calculate PV ratio. So what is the PV ratio here? PV ratio is equals to contribution divided by sales. What is the contribution? 21,600 divided by 72,000 into 100. That is nothing but 30%. Next here 24,000 divided by 48,000 into 100. That is nothing but 50% PV ratio. Okay na? 30%, 50%. PV ratio does not change because number of units increases or decreases. Still PV ratio remains the same. Overall is changed. Overall contribution is 45,600 by 1,20,000. That is 38%. Okay na? Next, what did he ask in the question? PV ratio, break even point, net income. Okay na? Net income already we calculated na. How much is the net income? 9,600. Break even point. Fixed cost 36,000 divided by PV ratio 38%. So what is the break even point? 94,737. If you want individual also we can calculate the break even point. Break even point is individually to calculate but fixed cost is not given. Fixed cost is not given, that is the reason we cannot calculate individually. Okay na? But sometimes in extreme situation we can apportion here fixed cost. Do you know? We can apportion here fixed cost on which ratio, you know? We can apportion the fixed cost on the ratio of contribution. In extreme situation, if you require, you have to apportion to product L, product M, then we have to apportion on the basis of contribution. Not on the basis of contribution. On the basis of contribution, you have to, on the basis of contribution, you have to apportion the fixed cost. So how much is the fixed cost they give? 36,000 into, what is the contribution? 21,600 divided by 20 plus 20, 40, 45,600. So that is nothing but fixed cost here 17,052, like that it will come now. Okay. Next, sales revenue is divided 40% to product L and 60% to product M. Again we have to solve the same thing now. So 1,20,000 into 40%, 48,000. Here it is 72,000. 48,000 into 70%, 33,600. So contribution is 14,400. Here 72 minus 36, contribution is 36,000. So this is the contribution. 14,400 plus 36,000. 50,400 minus 36,000, net income is 14,400. PV ratio 30%, 50%, it will not change. Here it will change. Why? Because overall contribution is changing na, 42%. Fixed cost by PV ratio is break even point. Finished as per his satisfaction. Okay na? Next, illustration number 9. Let us move on to the illustration number 9. Illustration number 8, everyone is comfortable na? Simple only. The main important thing is variable cost, everyone will forget. The main important thing is what everyone will forget. Everyone will forget about variable cost. That is the most important thing they will forget. Okay na?